If you're planning to invest your hard-earned money in stocks, bonds, and other assets this year, let humility be your guide. After all, markets were rocked in the past 3 years by events few predicted: pandemic, sometimes violent threats to democracy, Russia's widely condemned invasion of Ukraine. The list goes on. So what's in store for this year? The International Monetary Fund is predicting a recession for one-third of the world's economy, while Moody's Analytics predicts the United States in particular may escape an outright recession but experience a slow recession. But whatever the prediction, don't take it as gospel when it comes to managing your portfolio. Try this. Hey there, welcome to the Daytime Dollar, where we talk about financial strategies and how small changes can make big improvements. If you are new here, subscribe to my channel and hit the bell icon. Today we are talking about how to use the 2023 market crash to get rich. So let's get into it. Have a plan. It's hard to invest well in your life if you're unclear about what you need and when. According to Taylor Wilson, a certified financial planner, it is imperative that individual investors first create a financial plan that outlines their goals and financial situation before they create or rebalance their portfolio. That means also being honest with yourself about how comfortable you are taking risks, while also understanding that some risk is necessary to fulfill your longer goals, especially in a time of high inflation. Wilson said that every well-diversified portfolio has winners and losers, but the key is taking on just enough risk to reach your financial goals. Ignore the noise. Whether 2023 is great or awful for stocks or more likely, both at different times, that shouldn't sway your investing decisions. When it comes to success in investing, it's not about timing the market. It's about timing the market, Wilson noted. The best way to prevent that is to have a simple routine of putting away a certain amount of money each month across a diversified portfolio of stocks and bonds. What a sensible portfolio might look like. If you have a reasonably long time horizon but not a huge appetite for risk, a balanced portfolio of stocks to bonds might suit you well in the next year. Given recession concerns, Wilson noted that value stocks, which represent companies with strong fundamentals but are considered underpriced, tend to perform better during economic downturns. They typically pay a higher dividend, maintain strong earnings, and have lower price-to-earnings ratios. Higher-yielding bonds might also be an attractive option, Wilson said. For those with a long time horizon and a high tolerance for risk, Wilson suggests looking for buying opportunities among stocks that have been hammered. Look for good companies that have been oversold and avoid companies that may not have the earnings or balance sheet to survive this possible downturn. And for those close to or in retirement for whom preservation of assets is critical for the money needed in the next 5 years, he recommends creating a CD or bond ladder, since yields are at their highest levels in more than a decade. Treat crypto with extreme caution. The crippling crypto winter of 2022 pushed Bitcoin down nearly 65% last year. The stablecoin TRUSD fell to just 2 cents, a 98% drop from the US dollar to which it was supposed to be pegged. Meanwhile, several key crypto platforms like FTX, Voyager, and Celsius collapsed amid allegations of mismanagement and fraud. Whatever your views of crypto's long-term potential, it is still a very unregulated, uninsured space, which leaves individual investors highly vulnerable to losing their shirts when things sour. Don't invest money you can afford to lose. Certified financial advisor Ryan Sterling, founder of Future of You Wealth, advises his clients who typically have at least $500,000 of assets in their portfolios to keep their exposure to all crypto combined below 3% of their overall portfolio. And if their exposure falls below their initial allocation, Sterling wants them to leave it be. In other words, if Bitcoin was 3% of a client's allocation and it fell to 1%, they should not rebalance back to 3%. Know your limitations. No matter how smart or well-educated you probably are not a great investor. Don't worry, it's not you, it's your species. That's because humans easily fall prey to certain tendencies that can hurt their bottom line, according to behavioral finance expert Daniel Crosby. Being stressed or elated, focusing more on negative information, assuming you know enough to pick a winner, and preferring the familiar over the unknown can distort your investment decision-making. But by acknowledging those tendencies and working around them, you can negate their effect. Take the help of a financial advisor. For newer and seasoned investors, taking the help of a financial investor can be helpful. With growing inflation and uncertainty about global events, the markets may carry on to see some volatility in the upcoming year. Taking the help of financial advisors is one of the best ways to invest if you lack the necessary experience. Portfolio management schemes and wealth and investment advisors can guide you correctly and help you be a better investor in 2023. Although seeking help may make things easier, it is very crucial to do due diligence while selecting an advisor. It is important to take advice from licensed professionals, and their past performance and history should be known as well. As an investor, it is important to keep growing and changing along with the markets. The markets are always moving, and that should reflect on an investor's approach towards investing as well. Following certain rules and risk management principles and maintaining a diverse portfolio can help you be a better investor in 2023. Stick to your rules. Many new investors looking to learn how to invest in stocks often overlook the importance of having a system and sticking to it. As an investor, it is not necessary to have a well-defined system, but it is important to have certain rules that should be defined and adhered to. These rules can pertain to entry or exit conditions, time horizon, averaging, etc. in 2023. Creating and following your rules will help you be a more disciplined investor. Not only will it help you to teach patience, but it will also help you with keeping the emotions of fear and greed aside. So guys, that's all about today's topic. See you soon in the next video. Goodbye.